Hello and welcome back to the channel. The market never sleeps and neither does the earnings season. We are about to dive into the most anticipated financial reports for the week starting September 29. This week we have a fascinating mix of sectors, from global consumer giants to specialized industrial players and essential payroll services. Whether you are a long-term investor or a short-term investor, these 6 companies are crucial to watch. Our goal is to break down the key metrics, the critical challenges, and the potential market reaction for each one. We will cover what the analysts are expecting and, more important, and what we should be paying attention to. Make sure you hit the like button and subscribe, and also don't miss our analysis. This week's earnings lineup is packed with signals for smart investors. I'm watching 6 key names, and those are Nike, Paychex, Carnival, McCormick, Conagra, and RPM. From consumer demand to labor trends and industrial momentum, these reports could shape how markets move into Q4. Stay tuned as we break down what to expect and what it means for your portfolio. Nike reports earnings Tuesday after the bell, and all eyes are on digital growth. The company's online sales have been a bright spot, but investors want more, especially a rebound in China. With consumer demand shifting and global retail under pressure, Nike's results could be a key signal for Q4 momentum. Nike stock is down over 22% in the past year, trading near the lower end of its 52-week range. Despite forward earnings of $1.64 and the PE ratio above 42, investors are cautious. The dividend yield sits at 2.36%, but short interest is rising. This earning report could be a turning point, especially if digital growth and China rebound show real traction. Okay, so Nike's reports earnings Tuesday after the bell, and the spotlight is on digital growth, but investors are watching something bigger, a rebound in China. That market has been under pressure and it's showing into the numbers. Over the past year, Nike stock is down more than 20%, and over 5 years it's lost over 40% of its value. That's not typical for a brand this strong. Recent job cuts and margin pressure have raised concerns, and the chart reflects that uncertainty. For Q1, analysts expect a 5% drop in revenue to $11 billion and a steep decline in earnings per share, just $0.28 compared to $0.70 last year. The biggest drag? Tariff headwinds and the projected 40% revenue drop in Greater China. Still, Nike has a history of beating expectations, with 8 straight quarters of EPS surprises. If they pull it off again, this could be a turning point, but if the China weakness continues, the stock may stay under pressure. Paychex reports this week, and it's a key window into the labor market. With thousands of small businesses in its client base, and slowdown in hiring or wage growth tends to show up here first. Investors should watch for commentary on wage inflation and ESB sentiment, especially as labor costs remain sticky and economic uncertainty grows. If Paychex signals softness, it could ripple across broader market expectation. Paychex stock is down just 3.6% over the past year, relatively stable compared to broader market volatility. It trades between $128 and $161 with a forward PE of just 23 and a solid dividend yield of 3.41%. EPS is projected at $5.47 and short interest remain modest. These numbers suggest reliance, and the real story will come from their earnings call. If SMB hiring slows and wage inflation spikes, Paychex could signal broader labor market stress. Paychex is more just than a payroll. It's a real-time indicator of labor market health. With thousands of small and mid-sized businesses in its client base, any shift in hiring or wage trends shows up here first. This week, Paychex is expected to post earnings of $1.21 per share, up 4.3% year over year, with revenue projected at $1.54 billion, a 16.6% jump. That's strong growth, especially in a cooling economy. but the real insight will come from management commentary. Investors are watching for signal on wage inflation and SMB sentiment. The stock itself has held up well, down just 3.6% year over year, with a solid dividend of 3.41%. If Paychex beats expectation again, it could reinforce confidence in the labor market heading into Q4. Carnival kicks off earnings Monday before the bell, and it's a key read on post-pandemic travel demand. Bookings trends are front and center. If consumers are still spending on cruises, if signal confidence, and if demand softens, it could reflect broader economic cautious. Watch for commentary on pricing, occupancy rate, and forward bookings. Carnival's results could ripple across the entire leisure and travel sector. Carnival stock has surged nearly 64% over the past year, a strong rebound for the cruise industry. It's now trading near the top of its 52% week range, with a forward PE of just 15 and a generous dividend of 4.54%. EPS is projected at $2.02 and volume is high. This rally reflects optimism around travel demand, but the real test is whether bookings continue to accelerate. If Carnival delivers strong forward guidance, this momentum could continue and hold. Carnival's reports Monday before the bell, and it's a key moment for travel stocks. The cruise giant offers post-pandemic insights, with booking trends acting as a real-time pulse on consumer confidence. This quarter, analysts expect revenue to hit $8.11 billion, up just 2.7% year over year, a slowdown from last 15% growth. Carnival has a strong track record, 11 straight quarters beating ZEC EPS estimates, with an average surprise of nearly 170%. If forward bookings and pricing remain strong, Carnival could reinforce the bullish case, but if demand softens, it may signal cautious ahead, not just for cruises but for the entire leisure sector. Okay, so next up, two staples of the consumer goods sector, McCormick and Conagra. These companies offer stability when markets get choppy. McCormick is expected to post $0.74 EPS on $1.68 billion in revenue, while Conagra comes in at $0.60 EPS and $2.82 billion in sales. Investors will be watching for pricing power and margin trends, especially as food inflation cools. If demand holds steady, these stocks could remain solid defensive plays heading into Q4. Okay, so Conagra stock has dropped over 44% in the past year, now trading near its 52-week low. Despite the decline, the fundamentals are intriguing. A forward PE of just 10.4 and a high dividend yield of 7.7%. EPS is projected at $1.75 and short interest is elevated. Investors will be watching closely. If Conagra shows pricing power and stable demand in packaged food, this could be a value play in the defensive sector. Okay, so Conagra Brands is under pressure. Despite a forward PE of just 10.4 and a high dividend yield of 7.7%, investor sentiment remains cautious. For Q1 of fiscal 2026, analysts expect revenue to fall 6.5% to $2.61 billion and earnings to drop nearly 38% to $0.33 per share. That's a steep decline, driven by inflation, supply constraint, and softer consumer demand. Tariffs and elevated costs in packaging, labor, and logistics have squeezed margins with a projected 300 basis point contractions. Conagra has invested heavily in promotion and merchandising to offset volume losses, but organic revenue is still expected to dip 1.8%. If the company can stabilize margins and show resilience in its own categories, it may attract value-focused investors. Otherwise, this could be a sign of deeper structural challenges in the packaged food space. Okay, so for the McCormick stock is down over 21% in the past year, now hovering near the bottom of its 52-week range. Despite the decline, the fundamentals remain solid. EPS is projected at $3.84 with a forward PE of 21.6 and a dividend yield of 2.74%. As a defensive play in the spice and flavoring space, McCormick could benefit from stable consumer demand, but investors investors will be watching closely for margin trends and pricing power, especially as inflation cools. McCormick is a classic defensive stock, spices, seasonings, and flavorings that shows up in nearly every kitchen, but even this staple isn't immune to market pressure. The stock is down over 21% in the past year, now near its 52-week low. Still, it trades at a forward PE of 21.6 with a 2.74% dividend yield, and EPS is projected at $3.84. For fiscal quarter 3, analysts expect adjusted earnings of $0.81 per share, slightly down from last year $0.83. McCormick has beaten estimates in 3 of the last 4 quarters, but this time investors are watching more than just the headline numbers. The company reaffirmed its 2025 organic sales growth guidance of 1% to 3% and its long-term narrative projects of $7.7 billion in revenue and $1 billion in earnings by 2028. That requires steady 4.7% annual growth, not easy in a slowing consumer environment. With inflation cooling and demand softening, McCormick's ability to protect margins and drive volume will be the key. RPM International reports Wednesday after the bell, and it's a key read on industrial demand. EPS is projected at $1.55 on $2.19 billion in revenue. The company's exposure to construction and coatings make it a micro-sensitive play. If RPM shows strength, it could signal resilience in the industrial sector. But with margin pressure and slowing growth, investors will be watching closely for guidance. RPM has leaped 5.6% over the past year, but it's holding up better than many industrial peers. The stock trades between $95 and $142 with a forward PE of 20 and a dividend yield of 1.74%. EPS is projected at $5.76 and short interest remains low. Investors will be watching for signs of strength in construction and coatings. If RPM delivers solid guidance, it could reinforce confidence in the industrial space heading into Q4. This segment of construction forecasts show strength in performance coatings, with sales expecting to jump nearly 17% and consumer segment EBIT projecting to rise to $125 million. RPM exposure to construction and specialty coatings make it a micro-sensitive stock. If they deliver strong guidance and margin stability, it could reinforce confidence in the industrial space headings into the Q4. Now, let's recap the 6 earnings to watch this week. Nike, Paychex, Carnival, McCormick, Conagra, and RPM. Each one offers a unique signal, from consumer demand and labor trends to industrial momentum and defensive stability. Whether you are trading short-term or investing long-term, these reports could shape how markets move into Q4. Add them to your watch list now and stay tuned for the surprises. You have seen the earnings, the setups, and the signals. Now it's your turn. Drop your top stock pick in the comments and let's see who nails the biggest move this week. If you want more breakdowns like this, hit the subscribe button and join the Moneymaker Machine channel. New drops every week. Don't miss out. Thank you. Bye.